Alright guys, welcome to this episode on divergence. And what is divergence? Divergence is when the stock is, let's say, going to a bullish direction and your signals are starting to tell you that the momentum is about to die out. Or it can go bearish and the momentum is telling you that the seller is no longer in control and the buyers are coming in. Your signals will be the ones that were telling you what is happening before the candles start showing it. So for example, let's say you have a stock that is coming down, goes up, comes down, goes up, comes down. Your indicators should go with it. It'll be coming down, it'll come up, it'll come down. But then for some reason, rather than doing the lower lows, it kind of does one of these things where it's not breaking this lower low line like the stock did. It's letting you know that the momentum is dying for that direction. It's giving you a heads up. Okay. Same thing. If, for example, you have a stock that goes up, comes down, makes a higher high, this guy is lower than this guy. But on your oscillator, they'll be the same height. Letting you know that even though the stock went up higher, there was not enough strength to get it there, and you're pretty much the stock's going to start going down from here. So even though it looked good, they're giving you a heads up that the buyers were already, there was no more buyers there. Their sellers were trying to push the market down. Okay. Another option, another one will be you have a resistance line. Stock comes in, hits it, comes back down, hits it again, come back down, hits it again. And as this is happening, thinking, oh, will this break through? Your oscillator is doing one of these things, slowly working its way down. Telling you that each time it tried, it had less strength. So pretty much it's giving you a heads up that this is not going to happen today. Okay. All right. So now I want to show it on the stock, on the chart itself. So here we have a stock that's moving up, and you notice that the MACD and the Stochastic, which are the two that I like using the most, the Stochastic and the MACD are both oscillators. Meaning that they kind of measure the pressure, the momentum of the market. There's a bunch of videos on YouTube that teaches about this stuff. The way I use them, they're a little bit different. The Stochastic, for example, goes from 0 to 100. So it measures between the numbers. So once it gets up here, it can't go any higher. So I use it to find out when the market is going the opposite direction. So if the market is going up and the oscillator is on top, that's great for me. So when it starts to go down while the market is going up, it's trying to tell me that something is wrong. Okay. Also, the MACD is the same way. MACD got two lines. People use them for buying into the market and selling when the green line crosses over. I use them a little bit differently, and I'm going to show you here in a few minutes how I do it. The stock goes up, the two lines go up with me. It rests, the oscillators rest with it. It goes back up. They go with me, keeps going up, goes with me. But now I get to this little section here, as it's working its way up, notice that both oscillators are working their way down. Both of them are telling you that the momentum of the buying is not really there, while this is still moving upward. So it's giving you a heads up that the market is no longer going to be holding that. And then there it goes. It went from $56, only one shot, to 52. 56 to 52 and change in one shot. Then you know that, it was giving you a heads up way back here. This is how I use these oscillators. Okay, another example would be AMD. Here you have a, I knew it was going to move on me. There you are. Market came up, it hit, it came down, it tried to break again, didn't work, pushed back down, went back up. So it keeps trying to break through. But notice how the oscillators are telling you their energy is not there. Both of them are going down. So each attempt is trying, there's less and less buyers pushing through it. So eventually what happens? It falls. So you kind of know ahead of time if it's going to get through there or not. Okay. This is what divergence means. Divergence means that the market is giving you a heads up behind the scenes of what the candles are showing you. Another one would be ABX. And let's see, ABX. Well, here's a good one right here. You have a line right there. that it tried to break through, and the indicators are up here. It came down, worked its way back up, but look how far down it is. They're both doing the same thing. See, I like using two of them because sometimes they don't agree. If they don't agree, then I don't go with it. But if they're both agreeing, then that means that if I was already in this trade and I came in here and I tried a second time and I'm seeing this, I'll be selling. Because most likely this thing's going to come right back down again. Alright. So this is how I use these two indicators to help me with the divergence, and hopefully this will help you guys out. Keep making some money.